Money Talks, sponsored by Lexus of Las Vegas and Lexus of Henderson.
Well, as you know, credit card debt can have a crushing effect on our lives. And today is actually National Credit Card Reduction Day. And local financial professional Brad Zucker from Safe Money Advisors joins us to share 4 mistakes we should avoid making with our credit cards. Very important to talk about finances, especially today, Brad.
Oh, absolutely. Got to watch where your dollars are going and where they're being spent. And credit card debt is the most expensive kind of debt. It's more expensive than borrowing for college or a car or purchase of a home. More than 120 million Americans are carrying this debt month to month. And as interest rates move up, the interest on your credit card balance moves up. And today, the average credit card balance is being charged 17% annual rate.
But it's so easy to just swipe and use your credit card. You don't even think about how much you're racking up. So what are the mistakes that we need to avoid?
Well, the biggest one is making the minimum payment, because your balance goes up, so does the minimum payment, meaning it could take months or even years to pay off a credit card balance based on minimum payments. That's because of the excessive interest. It means it could take you much longer to pay off a debt because of the interest that builds up. And if you want to crunch the numbers to see what this really cost you, use our calculator right on my website at askbradzucker.com. There you'll see how long it takes to pay off the debt and how much interest you'll pay.
Now, you talked about minimum payments. What about missing a payment? You think about, what about this month? Just skip it this month.
You know, missing a payment doesn't seem like a big deal at first, but the interest on your credit card balance because of that late payment really increases dramatically. So the consequences for a late payment all depends on how many days that payment is past due. But if you're beyond 30 days, the issuer may contact the credit rating bureaus, and that might flag you for future loan options.
Oh, so how many credit cards should you own? How much is too much?
Well, the more credit cards you have, the more chances you have to go into debt. And every time you apply for a credit card, it actually hurts your credit rating. So if you apply for multiple credit cards, your credit rating gets hit multiple times. The average American has 4 cards. I recommend no more than 3 to 5 credit cards. Anything beyond that becomes difficult to track and really puts you in a chance of digging yourself into a hole.
All right, so what's the 4th thing that people should remember about credit card mistakes?
Well, be careful of a high balance. A high balance in your credit card could negatively impact your credit rating. You need to look to what's called a utilization ratio. In other words, if your balance is $5,000 but the credit limit is $10,000, then your utilization ratio is 50%. Experts recommend not to borrow more than 30% of your credit limit. And baby boomers are holding more than $8,000 in credit card debt. These are the groups of people that cannot afford to risk where their money's going or have high credit card debt. They need to learn how to reduce taxes, increase their income, and protect their life savings from the current volatility that we're seeing today.
Right, I think a lot of people are curious as well. Is there any way for you to reduce your interest rate?
Absolutely. That's a great question that you're asking, especially today because of the current financial times. Pick up the phone, call the credit card issuer, and you can negotiate that interest rate as well. That's a great question.
Awesome. Well, we'll take note of all those tips from you, Brad. Thank you so much for joining us.
My pleasure.
And of course, we'll be right back after this break.